Welcome to the Santu Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for April 23rd, 2017. Market breadth. With this past week's market decline, our bull-bear point and figure ratio at 1.33 rose slightly from 1.27 last week, continuing within bullish territory. The total count of securities in bullish or bearish patterns decreased 1% to 3,007. The count of bearish stocks increased 3%, while the count of stocks in bullish patterns increased 1%. The Santu Pirls P&F Market Breadth Summary Chart shows us a market now 23 weeks in bullish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe to the weekly Santu Pirls Stock Market Commentary via email, free of charge, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 19 points for the fourth advance in 16 weeks. At a negative 72.61 points, it continues below all 7 tops above plus 100, and it continues above all 4 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week also, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum, now at a positive 101.36, up strongly from a negative 101.23 last week. The CCI 20 daily had 5 consecutive days below zero before rising back above it. So our Woody's CCI 20 daily uptrend remains intact. We wait for the CCI 20 daily to return to the plus or minus 50 range for a valid zero-line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 51 weeks ago, while the daily CCI 20 began a Woody's uptrend 22 weeks ago. The CCI 20 weekly has risen to a positive 76.99 from a positive 66.51 last week. We await the return of the CCI 20 weekly to the plus or minus 50 range for another potential signaled trade. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: REITs and S&P Retail on top, banks, oil, and oil services on the bottom. Bullish, REITs continues in the top 5. Gold and silver has left the top 5. Oil services continues in the bottom 5. Oil has entered the bottom 5. Brokers, networkers, semis have left the bottom 5. Bearish, KBW Bank continues in the bottom 5. Computer hardware and disk drives have left the top 5. Focus this week from www.zerohedge.com, authored by Avi Galbert via MarketWatch.com. Bob Prechter warns market correction, quote, larger than the malaise of the 30s, end quote, looms. The following are some key points with a chart. I recently interviewed Prechter, who released a groundbreaking book, The Socioeconomic Theory of Finance, at the end of December. In the 813-page book, which took 13 years to write, he proposes a cohesive model that takes into account trends in sociology, psychology, politics, economics, and finance. I highly recommend the book. As I've explained here, Elliott wave theory says public sentiment and mass psychology move in 5 waves within a primary trend, and 3 waves in a counter trend. Once a 5 or V wave move, the waves are sometimes described in Roman numerals, in public sentiment is completed, it is time for the subconscious sentiment of the public to shift in the opposite direction, which is simply a natural cause of events in the human psyche and not the operative effect from some form of news. Avi Gilbert, you've said that once the stock market tops, you expect a major bear market and economic contraction to take hold. What is your general timing for this to occur? Robert Prechter, the true top for stocks in terms of real money, gold, occurred way back in 1999. Overall prosperity has waned subtly since then. Primary wave 5 in nominal terms started in March 2009, and wave B, up in the Dow gold ratio, started in 2011. Their tops should be nearly coincident. Gilbert, what do you foresee will set off this event? Prechter, triggers are a popular notion borrowed from the physical sciences, but I don't think there are any such things in financial markets. Waves of social mood create trends in the stock market, and economic and political events lag behind them. Because people do not perceive their moods, tops and bottoms in markets sneak right past them. At the top, people will love the market, and events and conditions will provide them with ample basis for rationalizing being heavily invested. Gilbert, you've said we will be mired in a depression-type event. How long could that last? Prechter, I don't know. All I can say for sure is that the degree of the corrective wave will be larger than that which created the malaise of the 1930s and 1940s. Gilbert, how are conditions going to change from what we have now? Prechter, the increasingly positive trend in social mood over the past 8 years has been manifesting in rising stock and property prices, expanding credit, buoyant pop music, lots of animated fairy tales and adventure movies, suppression of scandals, an improving economy, and, despite much opinion, fairly moderate politics. This trend isn't quite over yet. In the next wave of negative mood, we should see the opposite: declining stock and property prices, contracting debt, angry and somber music, more intense horror movies, eruption of scandals, a contracting economy and political upheaval. That's been the pattern of history. Safe havens. Gilbert, where do you suggest people hide during this event for financial safety, and why? Prechter, short-term notes of the least unstable governments, held in the safest manner possible. The plan is to trade those investments for stocks, property, and precious metals near the bottom. You can be calm and avoid suffering financially if you're prepared. The trick to maintaining personal prosperity is to avoid popular investments at the turns. It's not easy to do, but at a minimum, you need a fractal perspective on social trends as opposed to a linear one. Algorithmic trading. Gilbert, with the advent and proliferation of computer-executed trading, what effect have they had on Elliott wave analysis, other than the speed at which trading is done. Proctor, virtually none. People build their errors of thinking into their programs. Useful indicators. Gilbert, while we use various technical indicators to support or show the weakness in any wave count, my favorite has been the MACD. Do you have any favorites that have been most useful to you over the years? Proctor, nearly all momentum-based indicators provide the same basic information. There are hundreds of them because they are easy to construct, especially with computers. I don't chart rates of change anymore because I can tell what they look like just by looking at prices. But momentum analysis is not simple. In the stock market, slowing momentum nearly always precedes reversals. But slowing momentum does not mean a reversal must follow. The 1985 and 1989 through 94 periods are classic examples. In each case, the market slowed its rise, looking terminal from a momentum standpoint, and then accelerated. The most consistently useful momentum indicator is breadth. If I had to rely on only one momentum indicator, that would be it. Markets as fractals. Gilbert, do you have any specific time frames in charts that, in your experience, have provided the most insights into a specific market or commodity? Proctor, no. Markets are fractals. Nothing quantitative is meaningful or useful. Gilbert, there is a debate among various schools of thought as to what is more important, price or time. What's your perspective? Proctor, what matters most is form. Form involves both price and time, although arguably price is the more definitive component. Improving accuracy. Gilbert, I am sure you have seen a lot of time cycle analysis in your career. In my experience, I have not really seen any that have been better than 50-50. I am just wondering why you think we are unable to develop the same accuracy percentages in timing models as we do in pricing models using Elliott Wave. Proctor, I think the reason for your observation is that cycles are not the essence of markets. They are artifacts of the fractal form. They appear for a while and then disappear. Usually, by the time someone recognizes a cycle and bets on it, it is poised to vanish. As you say, the success rate is about 50-50, so I don't rely on them anymore. I think Fibonacci ratios between the prices and durations of related waves are meaningful. I wrote a book about Fibonacci relationships called Beautiful Pictures. Santu Pirls note our market signal includes Fibonacci retracements in its calculations. Gilbert, what are your top 3 arguments to present to those who do not believe in socionomics, but still hold fast to the old exogenous causation theories? Proctor, it took 800 pages in the socionomic theory of finance to present arguments, but I can make 3 brief statements. 1. Events and conditions that are often labeled fundamentals have no predictability with respect to the behavior of financial markets, so they cannot be causal. 2. Financial markets differ in numerous fundamental ways from economic markets, implying that their behaviors spring from different causes. The key difference is that in economic markets, the context is one of relative certainty with respect to one's own personal values, which allows for rational decision-making, whereas in financial markets, the context is one of pervasive uncertainty with respect to others' future actions, which prompts people to herd. 3. Postulating unconscious waves of social mood as a hidden variable explains a persistently compatible relationship among myriad social actions, from popular musical tastes to changes in the economy, to political actions, to women's fashions, to trends in the stock market. Thank you for watching this week's Sand to Pearls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.